Hello, everyone. We are thrilled to be part of TrendSpider's Election Playbook event. Now, there's a lot happening with this election. It's highly contentious, even compared to other recent elections, and traders are looking for how to position themselves both into and out of November 5th. For those of you who don't know, I am Brent Kochuba, founder of SpotGamma, and we provide analysis of how the options market is driving the underlying stock market. And there is a lot that the options market can inform us of, including what volatility expectations are and what positions are being taken in the market. So, what scenarios are possible for this election? SpotGamma's options-based analysis reveals two potential scenarios, one bullish and one bearish. On the bearish side, if the uncertainty around the election causes the S&P to break below the 56 to 5700 level post-election, then we are looking for heightened volatility and less supportive flows overall. We could quickly enter negative feedback loops due to heavy put buying. For the bullish case, if the election goes relatively smoothly and prices remain stable above 5,700, then we should see a big drop in the VIX and implied volatility, and we would look for the S&P 500 to reach 6,000 to 6,050 by the year end. And so with that, let's look forward to our election playbook and volatility and positioning ahead of the November 5th election. So what are we watching ahead of the election? Number one, market volatility. What does implied volatility? We'll refer to that as IV or vol. What is that showing us ahead of the election, and how does that translate to the market's overall expectations of price movement? Options prices infer how much underlying stocks can move, and that is what we're going to break down. Second, positioning. How are market participants gearing up for the election? Where are large players entering or exiting positions? We'll give you a hint right now. They're hedging their tails. And then the last thing is the key sectors to watch. Which areas of the market are most impacted by those upcoming elections? So first, we're going to start with volatility. How much movement does the market expect? I want to start this with bringing up TrendSpider. This is the S&P 500, and what is interesting about it is we are just a fraction off of all-time highs that were reached at the start of October, right around 5750 in the SPX. And so overall, you have to say this is a market that is not terribly concerned about risk when you consider that we are at these all-time highs. However, you can juxtapose that versus the VIX, and the VIX is quite elevated. And what's interesting about this is that the VIX measures S&P 500 options that are 30 days to expiration. So today is Tuesday, October 8th, when we were recording this. And so it is just in the last few days here that the VIX has started to price in the upcoming November election. And so the VIX is now at 2145, which is really quite elevated considering the fact that the S&P itself is at all-time highs. We can frame this a pretty interesting way. I want to show you what's called realized or historical volatility just to set the stage. So if we scroll down here, this is the SpotGamma platform. We're going to open this chart up, which is called realized volatility. And what I want to show you all is 1 month realized vol. What does this mean? Well, the barometer of how much volatility we should expect in the future is essentially how much volatility we've had in the recent past. And so what you see here is on a rolling 1 month basis, our current implied volatility level is just 9.7. And so that tells us that we're getting roughly 40 to 50 basis point moves daily in the S&P. It's not a lot of volatility, right? 0.5% roughly. And so you can compare this directly to the VIX and you say, okay, 1 month realized vol is at 9.7. Let's just call it 10. But the VIX, as we just saw here in TrendSpider, is 21. So that extra 10 points is a lot of that is related to the election and some of the other risks that we have. So the market is indeed bracing for impact with this upcoming election. I want to show you the way that people are really pricing this upcoming election period using some of our volatility tools. The interesting thing here is we want to start with this idea of term structure. Now, term structure shows us for each expiration day, and there's an expiration every single day in the S&P 500, what is the implied volatility associated with that expiration? Essentially, how much movement do traders see? And what you'll notice on this chart is it's fairly low in average as I draw my line across here until the election. So you see this big bump. So this is telling us that indeed there's a fair amount of hedging for the election. In fact, if you compare the volatility level before and after, you see it goes from about 13.5 up to about 16.4. Now, there's this very interesting rule of 16, it's called. And what you do is you just divide this number 16.4 by 16, and you come out with what traders expect is the daily move for the S&P 500. So what does that tell us? That right now traders are expecting only about 1% moves out of the election, which isn't huge, but it is larger than we've seen in previous elections. The other thing that's interesting here is if we flip back to TrendSpider, we can start to see where traders are starting to look or hedge themselves out. And one of the fascinating ways to do this is if you look at the VVIX, what the VVIX tells us or shows us is how expensive are essentially out of the money VIX calls. And as you can see here, they're quite elevated. This was the big August sell off around the yen collapse. And then we had a little bit of volatility in September. And we're indeed higher again in this VVIX metrics, which tells us that there's demand for upside calls. We'll be touching on that again in a minute. Another way to frame this is through what's called skew. Skew shows us the implied volatility for all options in a certain expiration. And so this expiration we're looking at is 11/7. So this is 2 days, the expiration for 2 days after the election. So it's 1 month skew is what we'll call it. And this shaded cone is the 90-day range. And so what you can very clearly see is that across the board, we can say this is call options and these are puts down here. So across the board, what we're seeing is very elevated volatility, particularly for these really far downside strikes. And this relates to an interesting positioning concept, which we'll touch on momentarily, that tells us that, look, traders are hedging their tails right now. And this has not only to do with the upcoming election, but also geopolitical uncertainty. So just to summarize this again, what we have here when we look at the VIX space is a very elevated VIX. We have a lot of demand for downside puts, tail risk in the S&P. We have demand for upside calls in the VIX. And we are currently pricing in about 1% moves for the post-election period. I would expect as we get closer to the election, the volatility that traders are pricing in starts to increase. So as I mentioned before, we have roughly 1% daily moves is what the market's pricing in with a 17% implied vol. I would expect that number to increase as we get closer to the election and more traders start to hedge the event itself. So that is a look at the volatility landscape. Again, traders expecting 1% daily moves, but there is a lot more tail hedging and people watching for sharp downside. So before we move on away from the equity vol space, I mentioned that we're seeing a lot of elevated volatility across other asset classes. And that's always a concern for us because, something like the butterfly effect, if you get a lot of volatility in rates or commodities, that can make its way into the equity complex. And so to frame this up, I want to show our founder's note from today. This is October 8th. And if I scroll down, there's this interesting chart from the SIBO. And what this is showing us is cross-asset volatility for all of these different assets. And what you can see here is, yes, the red line equity vol is spiking, but we also have vol spiking in oil due to the Middle East situation, as well as rates. Those of you who are familiar with the MOVE index, that index has gone from roughly 100, 105 right after the FOMC a few weeks ago. It's now up at 124. So that's telling us that there's a lot of volatility in that space, which is always concerning for assets. And then lastly, you can see FX vol right here, related again to the shifting rates, the yen and all of those other things. You can see that rate vol is jumping as well. So not only do we have this hedging into the election in the equity space, we have rates moving higher. The 10-year just broke 4%. So that's causing a lot of volatility and hedging in that area, as well as some of those aforementioned commodities. So this is a very volatile environment. Even if the election wasn't here, you would have quite a high volatility environment, which is always concerning for stability, for the stability of equity prices. So with that, let's move to the next section here. We want to talk about positioning and where are traders looking to enter or exit the market. Now, the big thing I want to start with is this skew index, because this helps to frame things rather nicely. What the skew index measures is the prices of out-of-the-money puts relative to at-the-money puts. So essentially, how expensive is tail risk protection? And what you can see here is that it's really relatively high. It's almost at all-time highs in this index, at least going back here to the mid-2000 teens. And what this is driven by is demand for fairly out-of-the-money puts, as I just mentioned. So For example, today we saw somebody buying a bunch of 4,700 puts from mid-November, and that is the target zone, that kind of just sub 5,000 area. Call it 10% out of the money to 20% out of the money. That's what traders are looking for to hedge. Where does this leave us in terms of positioning? Well, for that, I want to look at what we call gamma by strike, and this is again on the SpotGamma platform. And what you're seeing here is two sets of lines. You're seeing orange, which is call gamma, and blue is put gamma, and this is buy strike. So we sum the gamma for every strike using open interest. And the reason we do this, the reason that we weigh things by gamma by strike as opposed to open interest, is because gamma tells us how much hedging flow is associated with various positions. And so you can see here, generally speaking, this is the 5,700 level where we're currently trading. What you're generally seeing is through, call it 5,600 here, it's pretty balanced. What do I mean by that? Call positions and put positions are roughly equal. And when the market is in these regions, when the S&P is in these regions, we have stability of prices. Why is that? Because dealers and market makers, as they hedge, they buy the dip, right? So if the market starts to get weak, they start to buy futures or buy stocks, and that supports the market. Secondarily, if the market starts to rally, they start to sell shares or sell futures into that rally. And the net effect of that is that volatility collapses or contracts, right? We get a very stable market that tends to kind of drift higher. What I want you to notice here is under 5,600, which is right here, put positions pick up versus calls in a major way. So this is all the tail risk hedging we just mentioned in the kind of 4,700 area. But you really see those positions turn to net put positions in this general zone. When you get that situation, what happens is if the S&P breaks 5,600, then you're going to start to see market makers, instead of buying futures and stocks into dips, they start to sell them. And that could really speed up how quickly the market moves to the downside. So that's where we would expect to see, say, the VIX move significantly, 40 plus. That's where you'd see the S&P start dropping, 2% a day. That's where risk really rears its ugly head. So we think it's very important for traders to be watching this level because that is where market maker hedging flows will really start to push that market lower. It's also an interesting place because when you think about elections or just events in general, you can get a lot of short-term volatility as traders are reacting to headlines, right? Okay, one candidate has another lead over another candidate, and the market will jump down to that or jump up versus that. It looks like one country may retaliate against another here. You'll see the markets kind of jerk or respond to that. But the move tends to mean revert, right? The headline gets faded. In this case, we think headlines are generally apt to be faded until we break 5,600. If we break 5,600, then we're going to know that the selling, or we're going to really feel strongly that the selling is real, and then we would be looking for sharply lower markets. The next thing in terms of positioning to look at is back at these skew metrics. So I wanted to pop back because we alluded to this just earlier, that traders were indeed hedging or buying those out of the money options. And you can really see that here in the options pricing. The shaded cone is, again, 90-day average. So this is the 90-day average of 1 month skew. And you can see that there's this separation in here. And what that separation is telling us is that there is arguably excessive demand or extremely elevated demand for these out of the money puts. And so that is really the big takeaway here, is that traders are indeed buying a lot of these out of the money puts. The other place that you can see it is if we go and look at the VIX. And the VIX is interesting, obviously, because that is a great way to hedge of a very volatile event. And in this case, what you can see is that particularly it's this 35 to 40 strike calls, particularly if you start to look more on time, you'll see this. But statistically, these are being driven very high. And this ties into the elevated VVIX that we just mentioned. This is not like nosebleed, unbelievable levels of prices for VIX calls, but they are starting to elevate. And as we mentioned before, we think that these volatility levels, in other words, options prices, are going to start to increase as we get closer to the election and demand for hedges start to pick up. That pretty much covers how traders are positioned here. There is absolutely some tail risk hedging but traders don't yet appear to be reducing longs, as we can see by the fact that the S&P is again near all-time highs. So the tail risk hedging has come in, and it is not only related to the election, but some of these other events that we have. Okay, so what assets are most likely to be impacted by this election? We really have two key views here, and it's driven by the options positioning. It is that options positioning when it shifts that could really move some of these underlying stocks. The first thing we want to talk about is just the equity market writ large due to the options positioning in this elevated implied volatility. A lot of the banks are targeting, and you'll hear pundits out there targeting the S&P 6,000 level, which is this strike right here, as an end of year target. As you can see here in gold, there are tremendous call positions up at that strike, which we think does make it a big target into end of year. And we would also highlight this one right here. This is the 6,055 level. This is where a well-known trade called the JP Morgan collar strike is positioned, and it's positioned for 12/31 expiration. And so if we get the market to rally here, that will be a big magnet for end of year positioning. So for that reason, we really like this 6,000 to 6,055 area as an upside target for the S&P 500. Now, why are we leaning on a market rally out of the election? It's because of this idea of implied volatility being very elevated. And if the election is clear, regardless of who wins, if the election is just results that we can all believe in, and it happens in a fairly short time frame, that certainty traders really like, right? Doesn't matter necessarily which candidate I have, just tell me who the candidate is so I can make my investment decisions. If that happens, then what is likely to happen? Well, number one, the VIX and implied volatility is likely to start to drop sharply. And this ties into this idea of Vanna. So I want to show you this model because it helps us to frame this. In this case, we have the S&P 500 price on the x-axis, and on the y-axis here, we have what's called delta notional. So this is roughly how much, in dollar value terms, how much dollars have to be used to hedge out the S&P 500 options positions. So generally speaking, when the market goes down, dealers and market makers have larger notional exposure. Why is that? It's because they're short put options. So the market goes down and you're short puts, you essentially have more long exposure to the market, right? Because the puts are going against you and you need a market rally. So what do you do in that situation? Well, you sell more futures as the market goes down, and that offsets the exposure you have. So let's write this out. So if here we're flat, I'll have to sell, $1 million here, and then $2 million here, and then $3 million here, and so on, right? To maintain my exposure. Well, it works the other way too, right? So let's just say that we're sitting here and the election results come out. What happens? They're clear. There's a clear winner. VIX is going to drop. So the VIX is going to do something like go from 22 down to 15. And what that does is it crushes put values, right? Because those put options, there's so much tail hedging right now that those put prices are very expensive. They require a lot of hedging flow. When that implied vol comes down and like the VIX drops, those put values get crushed. The equity market does not even have to move for that, right? It's just that vol coming down. It crushes those puts. And so all those millions of dollars that we were talking about hedging shorts can all get bought back. And so the result is say roughly, rather than needing $30 billion to hedge yourself on a rally in the market, you're only going to need maybe something like $29 billion. And this is a very short-term metric that we're looking at here, but it frames the idea, right? That the decline in implied volatility means that dealers and market makers need less short hedges so they can buy that back. And that can be extremely powerful. That can drive really sharp rallies in the market. Let's frame this a little bit. If you look back over the last 1 to 2 months or so, what you'll see is a couple of extreme volatility events. Number one, we had the VIX print over 60, right? So VIX 65 in this area. And then we had another volatility kind of spike right around September 11th. And you'll notice how quickly both of these moves mean reverted. We believe this is in a large part due to traders coming out and shorting high volatility levels. What does that mean? They come out and they sell put options or they short the VIX. They do those types of trades And that helps to rally the market very sharply because it creates buying flow for dealers and market makers. And so in this situation, while we're sitting here, we're waiting for the election results to come out. If the election results are clean, again, that could create this buying impulse that could really push the market higher just on the back of this flow and positional analysis that we have just conducted. And so again, we're really watching that 6,000 level, which is a pretty healthy 5 to 10% rally in the S&P 500. There's one other name that really catches our eye in relation to the election, and it's very clean and simple to, we think, run this analysis. So, what are some of the other sectors that traders are looking at? The cloudy picture here is due to the rate and geopolitical situation. If you look at like the energy space, it has had a fair amount of volatility. Volatility levels, as you can see here, they're all askew. They're kind of a mess because of the geopolitical. Uh, they're kind of a mess right now because, and they're really tied more to geopolitics, we think, than elections. The second thing is obviously the rate complex. We mentioned that before. So if we look at something like TLT skew, you can see that where there is a bump related to the election. As you can see here, this is suggesting that bond prices are tied into which candidate's going to win. But there's also just a lot of vol, generally speaking, because of the fact that, for example, the 10-year has just broken 4%. So that's very clouded. And we think that there are other exogenous factors besides the election. The stock that is the most interesting election related name, however, is Tesla. It's no secret that Elon Musk is really dialed in or tied to the Trump campaign at this point. In fact, in a recent interview, he said if Trump doesn't win, he's in trouble. I'll put it that way. And Tesla has had a tremendous rally over the last couple of weeks and months, as you can see here. And as we sit here on the 8th, they are going to announce robo taxis. They're going to give us a robo taxi update on the 10th. And if you look at the volatility positioning in Tesla, what you see is that there is the robo taxi issue here, and then you have the upcoming earnings on 10/25. So those are both very big events. If those turn out to be bullish, then we could have a situation where Tesla is really starting to prime and could be very easily testing this 250 to 260 area. Why do I think that? Well, let's look at our equity hub positioning, and I'll show you where the big option strikes are. So in this case, just in how we were looking at put and call positions in the S&P, orange is call positions, blue is puts. You can see there's a ton of positions here at 250. We think that is a very near-term magnet. So into the robotaxi and earnings events, that 250 to 260 area is very big. You'll notice there's a bunch of positions here at 270, and then we see 300. I think that if Trump wins the election, we're very quickly going to see Tesla rip. And if the robotaxi event is good and if their earnings are okay, that move, right, or Trump kind of maybe resetting Elon's relationship with the federal government in some respects could be extremely bullish for Tesla. And it could really reestablish it as one of the top stocks in the S&P 500. I wanted to show you the implied volatility positioning here. You can see from a 1 month basis, what we see is what's called a mild call skew. What does that mean? Well, if you look at the at-the-money options, Tesla's currently trading here, and you look at these upside strikes, they have a higher implied volatility level than the at-the-money. So this is telling us that there is a lot of call demand for Tesla into the robotaxi event, and then this could continue into the election period. If we zoom out a little bit more and just look at end of year positions or in the volatility space, so I want to check the January expiration in this case. What you're going to see is that the positioning is much more neutral. So in this case, you see there's a little bit of a call skew. It's pretty flat, but the options are not really very elevated. And so what we think is going to happen is if Trump does win the election, we do think that that's really going to benefit Tesla more than anything else. Tesla is a name that a lot of options call buyers like to come out and charge into that name. And so we think that this could really lead to Tesla looking up at this 300 level. Now, the flip side of this coin, obviously, is if the robotaxi event is not all that inspiring and the earnings aren't that great, and then if Trump doesn't win the election, well, then you have to really start looking at the opposite end here to start looking at that 200 level. We think after the election. So uh, Tesla, we would argue, if Trump wins, very bullish for that position, and with all those calls struck at 300, we think that could be a real magnet for that stock. So that about wraps up which assets are likely to be most impacted by this election. Again, we think equity markets writ large with any type of a clean election, we could really see a rally. And then the second side of that equation is Tesla, which if Trump wins, it could be a real major event for Tesla. So, with that, we want to thank you very much for watching our election preview here. If you have any questions, please come over to visit us at spotgamma.com. We run a proprietary options analysis every single day and have been doing so since January of 2020. We have a bunch of amazing tools that allow you to understand how the options market is moving the underlying market. And if you should have any questions, email info@spotgamma.com or check us out at SpotGamma on X.